Good evening, everybody, and nice to see some of you back again 12 months later. I'm going to cover the analyst presentation that we gave this morning to the exchange because our annual results came out earlier today. But I'm going to do it fairly quickly and try and leave some time for questions at the end. So if I'm going too fast, do sort of note the bits that I'm missing and then perhaps ask a question at the end, and apologies in advance. So that's the structure of the presentation. So some highlights and then a quick bit of background for those of you that don't know us, and then business and financial update, and finally the prospects for the company. So Impax Asset Management is an investment manager focused in a particular area of the market, which is those industries that are participating in the transition to a more sustainable economy. So we've historically invested in the clean energy sector, water sector, food, agriculture, waste management and associated infrastructure industries. And we pitch ourselves, our services are being marketed to pension funds, private banks, insurance companies, who generally speaking are looking for growth opportunities, and in some cases are looking for products, financial products that are helping them to reduce their risk footprint. So over the last 12 months, we've very strong growth. We've increased our assets under management, AUM, by over 60%. We've had record inflows of over £2 billion. Very good investment performance, strong fundraising for our private equity fund, and we have, as Hannah said, announced the acquisition of a US company that's actually been a client for the last 10 years. These are the financial metrics, so very strong increase in just about everything over that 12-month period, like for like. And it's particularly pleasing to be able to announce the board is proposing a substantial increase in the final dividend. Again, all these numbers are in the pack, so if I'm going, that you've got on your seats hopefully, so if I'm going faster than you like, please just refer to the pack in front of you. So a bit of background on the business. I started the company back in 1998, and since then we've really been consistent to our core investment thesis, which, as I said, is helping clients in this particular part of the market. In the early years, we were exposed to quite small cap environmental technology type stocks, very volatile, and performance was quite different, shall we say, to the performance of the index, the CI Global World Index, for example, or something similar. Today, we are investing much more in the central part of the economy, as the industries that we have expertise in are mainstream part of the economy. So £7.3 billion under management at the end of our year, at the end of September. We announced that at the end of October we'd reached £7.6 billion, and with Pax we will add another £3.4 billion or so. There's a little bit of double counting in there, so if you add the two numbers together, you need to subtract about 300 million to get to the right aggregate amount. So the business is known globally as one of the leading investment managers in this space, and so we do have a very attractive offering to clients where we can say that we've got 20 years of track record with a stable team, really unpicking the investment opportunities in the sustainable development space, and we have a very large client base with over 75 institutional clients around the world. Investment managers at the moment are under pressure to justify why they are charging fees, why they exist in some cases. And so for those of you that know the investment management sector, you will realise that there is a splitting, a bifurcation of the industry into those that are offering cheap, quite often passively managed strategies, high volume, low fee, and on the other side of the barbell, the actively managed, specialised offerers who've got a differentiated product. And in the middle ground, there is a question as to whether there's a differentiated offering there, and so you've seen mergers of groups like Henderson and Janus, who I think are pursuing, or Standard Life and Aberdeen, who one could argue are pursuing scale in order to get critical mass and compete in this sort of first half of the barbell, as I describe it, the shift towards low-cost product. I'm not commenting on their offerings, but I think in contrast to the general trend in that passive equity space, Impax does have a very clear differentiated offering, and that's increasingly resonant with where asset owners are looking for new investments into industries that are growing rapidly and into industries that have got very strong risk characteristics. So Impax's investment philosophy, essentially, as I've mentioned, is articulating the idea that as the world copes with more and more people, going from 7.4 potentially to 11 billion people on a finite planet, there is going to be more and more opportunity, business opportunity, to improve the efficiency with which resources are used. And urban populations in general, are going to put pressure on politicians to ensure that air quality, water quality, land quality is sufficient to support a habitable environment. And if you take that logic through to its natural conclusion, there are an enormous number of business opportunities around resource efficiency improvements and around environmental quality improvements, which manifest in infrastructure investment opportunities and also opportunities to invest in rapidly growing companies. So that's very much a mainstream capitalist type investment idea. This is not about ethical investing, it's not about social responsibility, as we define it. However, those pension funds or charities or family offices that are interested in ethical investing, social responsibility, do tend to like what we do, and so we have a number of clients with those objectives too. This chart shows my life for the last 20 years. So back in 1998, the first client was $25 million, and since then we've grown the business through thick and thin, a couple of major market setbacks, and this year, compared to this platform, not this particular platform, but the equity development platform, literally a year ago when we had announced £4.5 billion under management, you can see that we've really made very strong progress over the 364 days. This is a detailed slide that just shows the range of investment strategies that we're offering in those three buckets, so thematic global equities, unconstrained global equities, and real assets. I will leave that for you to read afterwards if you're interested. How do we sell our products? Well, I think in investment management there's always a trade-off between, do you spend your time managing the money or do you spend your time talking to prospective clients? And so what we've done is we've decided that managing the money is the core of a successful business, so we've devoted the vast majority of our resources to doing that, and then we've teamed up with third parties to get access to pools of capital around the world. We've done that in a very differentiated fashion, so we've got individual country partnerships, for example in Denmark, the Netherlands or Canada, but then we have multi-country partnerships, in particular with BNP Paribas, that cover much of continental Europe for us, as well as places like Australia and Japan. So a mixture of direct sales in the UK and the US, and largely going through third parties in other geographies. And we do take a long-term partnership approach to our clients, offering them not just investment management services, but also access to our research. So the business updates, I'm just sort of counted through the key messages here, and the slides you can digest later. But essentially, the investment performance has been very strong over the last 12 months. We've kept pace with the market, even though the oil stocks and financial stocks we don't typically have exposure to have had a very good resurgence or recovery from being very significantly out of favour just over 12 months ago. So that's been a bit of a headwind, but we've more than countered that with our alpha generation. Our growth has come predominantly from continental Europe and North America, so the light green bars show where we were in terms of our client base, the numbers being the assets under management for each geography 12 months ago. The dark green bars are the 12 months later, i.e. the snapshot at the end of September. So the big increase in EMEA is reflective of the significant absolute growth coming in that region, particularly continental Europe, and in percentage terms, North America is growing very nicely as well. A bit of a complicated chart on this one, but this essentially shows that on the left-hand side, the vast majority of the growth has come from inflows. There's the blue bars, which means new money coming in. Outflows, i.e. money going out, has been limited. And the revenue margin shown on the right there has been slightly reduced as a result of changing business mix, but we're still getting more than 50 basis points or 0.5% annual fee on the money that we manage. So that's, as I've described so far, our listed equity business. The other side of the business is private equity, where we are the final stages of raising our third private equity fund, investing in the renewable energy sector, funding the construction of wind farms, solar projects and hydropower assets in Europe, at the moment excluding the UK, so France, Germany, Finland, Ireland, etc. And this is something we've been doing since 2005, got a very strong financial track record, and we've attracted capital from all over the world into our third fund, which currently sits at 303 million euros. It's quite attractive fees on that, and so it is quite an important part of our P&L. Just to cover the Pax acquisition, then Pax is a fund manager in the United States, Portsmouth, New Hampshire. They were set up in 1971, actually as one of the first socially responsible investment managers anywhere in the world, set up by some Methodist ministers. Today they've got about $4.5 billion under management with a team of 50 people, majority owned by a family which doesn't participate in the business, and the family decided about 15 months ago they wanted to sell their stake. And long story, but we've agreed to buy that stake and also the remaining equity which is owned by management, which we will buy through a share swap in 3 years. The reason that Pax is attractive is several-fold. First of all, it's very complementary to our current business, so they have products which are very additional to our offering. Secondly, they because they're dedicated to the US, they allow us to move from being essentially a European manager with a toehold in the US to being a manager with almost equal footprint in terms of assets and clients in the US and in Europe. Thirdly, their transaction allows us to improve the efficiency with which our balance sheet is being used. So we've used a good portion of our excess cash, and we, for the first time, we will be taking on board a modest amount of debt to fund the transaction, and that really makes our balance sheet efficient in a way that it wasn't beforehand, or we haven't quite closed yet, but when we do close, the efficiency will improve. The particular attraction about Pax is that we've known the people there for 10 years, so we've been a sub-manager for them for that 10-year period, and that meant that we, from my sort of CEO level all the way down through the organisation, we have personal relationships and a track record of growing a fund from scratch from $1.5 million at launch to over $550 million today. So that's a real excitement about the deal for the teams on both sides, is that history of working together, and the strategic rationale is quite compelling for shareholders and for clients in both groups. This is a mapping of the investment capabilities across the two firms. So they bring us deeper investments expertise in the US, and they've got some passive equity funds and some fixed income capabilities. And so we're going to be able to cross-sell these capabilities in both directions. So our strategies are managed out of London to their clients to a greater degree, and some of their strategies we think will be marketable in Europe and Asia. A lot of words on this page. This essentially is a summary of the transaction, the deal. So essentially we paid about 9 times run rate EBITDA for the initial consideration, and if we pay the earn-out in 2021, that will be at an even lower multiple. So relative to market norms, that's a pretty cheap deal, and we are buying a company that's very well run. We're not expecting to make any redundancies. The management team will stay in place, and we will be slowly knitting together the two groups, taking our 80 or so staff up to about 130 with 50 people at Pax. And this chart shows the structure for the company today. We've got sort of 2 regulated subsidiaries, and Pax will become a 3rd regulated subsidiary, and will change its name to Impax at closing. Closing we expect to take place before the end of February. There are a couple of fairly mainstream or normal conditions precedent to closing. And this chart shows how the combined group will look. This is dated at the end of July, which is what we announced at the time of the transaction announcement in September. So in simple terms, EBITDA goes up by a little bit over 40%, but dilution to shareholders is less than 5% because we're using cash and debt as the primary sources of the consideration, funding of the consideration. Hence the efficiency of the balance sheet, and I think the market did reflect in Impax's share price the efficiency with which this uses our current resources and the sort of EPS enhancement that we can expect as a result. Financial update. These are terribly complicated slides. Charlie does a brilliant job. It's Charlie Ridge on the front row, Impax's CFO, does a brilliant job in explaining them. And so let me just say in summary that going back to that very first chart, that we've had very strong increase in revenue as a result of the AUM coming into the business, assets management coming into the business at pretty much the same fee margin. Our cost base has increased a little bit as a result of incremental headcounts. We do pay 45% of our 45% of our pre-bonus profit into the bonus pool, so operating costs have gone up as a result largely of bonuses going up. We've had a little bit of transaction costs associated with the Pax World transaction, but essentially that's meant that operating earnings have jumped up quite considerably. On the right-hand side of this chart, you can see here that the 2.2p final dividend will allow us to honour our commitment to a progressive dividend policy, so we're committed to paying out substantial amounts of our free cash flow into dividends, and despite the leverage that we're about to take on board, we'll plan to continue that. I won't attempt to address that slide, except to say that we have quite substantial investments in our own funds as sort of seed capital positions, and even post the debt and the transaction with Pax, we still have plenty of cash as a buffer in the business. And this chart, I think, is one of our favourites because it does show, page 28, the operating leverage in the business. So as the assets under management have grown, we've had modest increase in headcount, and we've kept our fixed costs under control. So there's no reason why this can't continue, as our offering continues to resonate with asset owners around the world, and our distribution architecture continues to deliver. So final comments, and I think I'll just leave it 5-10 minutes for questions, assuming you have some. Prospects for the business. Well, at a time when equity markets around the world are quite healthily valued by most metrics, then asset owners are even more hungry for ideas to find pockets for growth and outperformance, while at the same time being mindful of new risks emerging in the economy in general and in corporations. While at the same time, the sort of third driver is stakeholder pressure, societal pressure, regulatory pressure for asset owners to be mindful of their impact on society, and to think carefully about how they are acting as stewards of the companies in which they have direct or indirect exposure. So in that landscape, then Impax really has a highly attractive offer, because we've got 20 years of demonstrating investment outperformance in areas of rapid market expansion. We've looked after the risk side of our work very respectably, and we've got very good performance metrics around stewardship. Our business model is very well placed for scaling, for scalable growth, because we focus on investment management first, and then we have a partnership approach to global marketing, and with what's now effectively an internationally recognised leadership brand in the space and high levels of endorsement around the world, we have strong conviction that we'll get a lot of additional business on the back of an existing client base. And when you ripple that through to the consequences for shareholder value in the narrow sense of the word, or the phrase, then we're very confident we can continue to scale the business, which should lead to rising levels of profitability and therefore dividend. And finally, the Pax acquisition really sets us up for a new phase of growth and even greater levels of ambition, bringing additional products onto our platform, and a deeper team that should give investors, asset owners around the world, even more confidence in our ability to continue to deliver.